I have got topic proposals from Tilini Chapman, Trevor Vishwin, and Mahil Kavind.
Yes, sir.
What's your company, Mahil?
Bartley.
Bartley, right. So what are the other companies that are represented, please? What are the other companies represented? How about George Stewart's? Now, Trini Chapman, your topic falling foreign reserves and economic penetration of financial institutions. I think we discussed some subtopics. Did you take it down? Tilini from Chapman, did you take those subheadings down yesterday when we discussed? Then Bartlett's challenges for money brokers during an epidemic like COVID-19. Your subtopic suggested was government decisions which affect the money market,
Yes.
then effect on foreign exchange market, call money market and bond market. Then third on downfall of forex volumes. Import, the fourth one, impact on money brokers, right? Impact on money brokers.
Yes.
Then fifth one is new ways to face these challenges. One thing, Mahil, this should not take a narrow path of expressing the difficulties money brokers are facing. It should take a little bit of academic weight as well.
Yeah.
So now all depends on the first subheading, government decisions which affect the money market, right? Now, as a result of the pandemic, you can indicate the transportation and then now communication abilities was not interrupted. No? Communication abilities was not interrupted. In fact, many of you had the opportunity and luxury of operating from your residences.
Yeah. Work from.
Yes. And that created a little bit of benefits as well because you were able to contact the clients, the bankers, and the primary dealers from residents. And then the impact was that one of the impact on forex market was that because of prohibition of importation of vehicles, the vehicle market dried down, the foreign exchange activities which went through the market for import of vehicles was not there. At the same time, we can cite examples such as the garment industry, which was about $4 billion plus or more, right? Garment industry is more. About, I guess it's about 10 to 11 billion turnover of garment industry, but 11 billion, out of which the import of yarn or whatever the raw materials was about 7 or 8 billion. So total, we are talking about turnover about 15 billion a year in US dollar terms. So because of the ability of the garment industry, they were able to switch very quickly to personal protective equipment manufacture, like face masks and the gowns, and then the health workers wear their kits before they attend to the COVID patients. And that had a big demand world over. And Sri Lankan garment industry, in fact, switched very fast, that some of the companies turnover exceeded those proper garment manufacturing turnovers. In fact, some of the employees of those garment factory companies, employees, although first 1 or 2 months their pay were reduced because of the less income, but from the third, fourth, fifth month onward, they were paid even 1.5 times more than the previous wages, because they had that type of success in turning it around to switch into new products like face mask, and then those attires that are required, personal protective attires that were required by the health workers. So, the type of success stories. And the third sector is that the tourism, when tourism actually dried down, it was total chaos. And then, so the foreign exchange, whatever the turnover that came to the market was not seen. So that all those individual turnover in respective industries contributed to downfall, except for garment industry, which had a tremendous upturn from the second or third of month of after the pandemic set in. You can also find some information about the tea industry and rubber industry, and also overall agriculture sector, and then how they contributed to the volumes of exports and imports. Then, so impact on money brokers definitely is that the dwindling volumes and increasingly the government decisions through the Central Bank of Sri Lanka to restrict the volumes perturbed the day-to-day transactions of the market, and thereby the money brokers earning capacity or the business volumes reduced drastically. And at the same time, when the foreign reserves are on the downward hill, the central bank came out and then imposed various restrictions, such as 100% cash margin on imports of luxury goods. So new ways to face the challenges is there is no quick solution, but to revamp the entire economic activities and the cycles of the Sri Lankan economy. Whereas to start with, on the short end of on the short end of the curve, the government has to enhance their revenue. There was a problem as soon as this government came to power in late 2019 and in the year 2020. There was a big tax reduction. The VAT came down from 15 to 8%, isn't it? And then various other personal income tax thresholds were raised so that less people had to pay taxes, and the corporate tax was also reduced for corporate companies. And thereby, the government lost revenue up to the tune of about 700-800 billion rupees. That has to be fixed. Then, second thing, as we discussed yesterday, when I explained the bigger Chapman topic to some extent, that we have 1.5 million workforce employed in the government service with, least productive work carried out by them. But the government revenue by way of taxes is spent on salaries up to about 85% of the total revenue. So if there can be some arrangements and then thought process to automate the government service or delivery of government services to the general public, and then remove a good percentage of the government servants who are supposed to be educated, most of them are graduates, to be employed in productive areas which contribute to, sometimes you can say, better education of the children and the young adults, and better transport service, better communication service, which all are requirements for foreign direct investments to come in. Thereby, the inward cash flows from foreigners to invest in Sri Lanka. One of the biggest bottlenecks to foreigners to come and invest is that inferior quality of government service. So if that can be rearranged, I think more than 50% of the problem Sri Lanka is facing is solved. So because of the unproductive and lethargic nature of the government services delivery, the foreign direct investors, when they have to spend a lot of time in seeking approval for certain projects, they run away from Sri Lankan investments. If all that can be automated, and then if the approval processes can be delivered with the shortest period of time and with only one or very few touch points, if the approvals can be finalized with a positive note, then there can be a lot of foreign direct investments. So those are the few things that I can off the cuff tell you. And if those proposals are really implemented within about 1 or 2 years, maximum 3 years, the foreign reserves and the forex market volumes will rise, and then the money brokers challenges will be overcome, and finally the entire economy and economic activities will develop, so that the money brokers volumes and then the business quantities and the number of products that are available could be increased because of the increase in volumes. Okay, so that's some explanation to Mahil and the team.
Thank you, sir.
Okay, then Trevo and the Vishwin team, Sri Lanka forex market, current foreign debt crisis. So there are answers in what I said up to now, but Trevo and the team, if you can send me the suggested subheadings, we can discuss further. Okay, Trevo?
Hello.
Yes, sir. Got it, sir.
Yes, Kasaba, any comment?
So that topic regarding falling reserve and economy, that Pikachu Japan company.
Yes.
Topic, sir. Yesterday you explained about that, but sir, there are some technical issue in our side. But most of the time we didn't get the points to talk about.
Could you please, Kasaba, write down some subheadings and send an email so that
Okay.
I can add some value to that.
Okay. Sir. And sir, another thing, sir, in the assignment, sir, there's suggested paragraph in here, sir, mindfulness and facilitating customer benevolence. What do you mean by
Yes.
that, sir?
Very good. Good question.
Yeah.
Now, what is the exact meaning of mindfulness, Kasaba? In Sinhala, Satimat Bhavaya. Mindfulness. That means when you are entrusted with a certain job of work, whether you understand the exact responsibility and deliver the what I expected. I think I don't know whether I discussed an example some time back where in a rich household and an elderly or aged lady wanted to go on to go to a monastery and then meditate. She goes for about 1 or 2 weeks or 3 weeks or 1 month at a stretch. So once or twice she found that her house was burgled and belongings were looted by the thieves. So she decided to employ a watcher or caretaker. So now then she made up her mind. She went next time when she went for meditation, the watcher was briefed to look after the household, and she went. When she came back after a month or so, she again found the house was burgled. So she summoned the watcher and then asked, what are you doing when you asked to take care of my house and property? He said, I was asked to watch. I was asked to look after. I just looked after. I saw them coming. I saw them taking the goods and going. I was watching. So did that watcher or the caretaker understand what was expected out of him? No. He was actually was expected to prevent anybody entering the premises and looting the house, but instead he was watching. So that is the mindfulness, the complete lack of mindfulness. Another famous example that I can indicate on mindfulness is that now, as you all know, in the banking and financial markets, the central bank has issued several directions and guidelines based on some parliament acts of specific three parliament acts, namely Financial Transaction Reporting Act, Prevention of Money Laundering Act, and then also Convention on Suppression of Financing of Terrorism Act. These three are very superlative parliament acts with its superpowers, meaning when one issue is discussed in this one of the three parliament acts, and same issue is discussed in a different parliament act, the way the provisions on these one of the three parliament acts will supersede the provisions of the other parliament act, which is example is that now the bankers and the finance companies are expected to protect the confidentiality of the customers, right? Depositors and then borrowers. That's the provision in Banking Act 1988 and subsequent amendments. But on the Financial Transfer Reporting Act, there's a provision that customer information, when they are of little bit suspicious nature, they must be reported to the Financial Intelligence Unit of the central bank with confidentiality. So although the Banking Act says customer protection is paramount, customer information cannot be shared with anybody else other than out of a court order. But the provision in this Financial Reporting Act says that any suspected activity of a customer, even without telling the customer, intimating the customer, without permission from the customer, the banker or finance company should report such activity to the Financial Intelligence Unit of Central Bank. So likewise, when the know your customer or KYC regulations are in place, some of the bankers and some of the finance companies, what they resort to are that they make a list of KYC items like name, address, NIC, employment, and then a few other things. And then they just perform a tick box after having copied the information, may not be accurate, or sometimes the customers may give bogus information and then open accounts or take loans, whereas they are resorting to various money laundering activities and then terrorist financing activities. So what these people are doing is that the bankers and finance company, when there is a set of rules requiring them to obtain know your customer data of customers with at least average intelligence, because central bank expects the employees of these banks and finance companies to possess at least average education and intelligence in dealing with customers. But the customer information gathering process is mostly limited to a tick box in a application form. It is not very well practiced with common sense, whether the customer is coming with money looted from somewhere else or after obtaining a bribe or when the actual beneficial owner is somebody else, they come and open accounts in different names. There was one example at when I was working for HNB, and one of the PETA customer, trading customer, he had opened an account in the name of the sales assistant, a young fellow, not educated, just that Mudalali's very loyal servant. And then it was a current account, and then the money or the balance built up in the current account. Soon after account opening date, second, third, fourth day, or within a week, the balance built up was up to about 20 million rupees. A current account carrying a 20 million rupees within a week after opening, isn't just suspicious? No interest. So when we casually inquired, the money was taken away in lightning space. So there was an inquiry conducted, investigation was done. Finally, the findings was that the Mudalali had some business concern in the northern province, and northern province businesses were sold, and the money were deposited to the sales assistance account. Actual money was belonging to the Mudalali. So finally, there was some investigation and then some conclusion. So therefore, because of these things, the mindfulness is that when there is some responsibility entrusted, the responsibility must be carried out in good faith. And then any lapse of human nature, any lapse of human nature can be explained. But actually, there should be full effort or endeavor to fulfill the duties and carry out the duties as expected. It shouldn't be like the watcher who was to protect the house and household and then was watching when actually he was asked to protect it. And then also when the bankers and financial company employees, when they asked to actually gather the customer information, just resorting only to a tick box in an application form. So these things are to be applied in any industry. So mindfulness, or in Sinhala Satimat Bhavaya, is carrying out the expected role or duties with responsibility. Okay, Kasava, can you apply that to your topic?
Yes, I got it, sir.
Okay, so other few 2 or 3 companies, please send me your chosen topics, and then we'll discuss like this. All right. Okay. So today I thought of discussing with you a new set of slides, but the subject covered is not new. The asset and liability management activities in treasury management. This is basically is basically overall coverage, of the treasury activities. As you see the covered discussion points, you you'd see that all these aspects has to be understood by the treasury managers, who are the managers of the pool of funds or the wholesale banking activities of licensed commercial banks, licensed specialized bank and finance companies, primary dealers, and insurance companies, and other managed funds. So far, our discussions in the previous few weeks, this picture gives you a summary of that, whatever we discuss. Now, assets and liability management is basically, liabilities are the depositors' money and the capital funds. When a bank or a finance company or a primary dealer or insurance company manages the funds, they deal with somebody else's money. Shareholders initially with the provision of share capital. Then the depositors, they deposit money on trust, and they will want to withdraw it on demand or after contractual period of deposit, and they would want an interest. And assets are that out of the capital funds and the depositors' money or the investors' money, the assets that are acquired, like loans, investments, and the types of assets. As you all know, in a balance sheet, you get two sides, the liability side and the asset side. So asset and liability management is another name for the wholesale banking activities of these financial entities, which are the real crux of the business on treasury management. So these are the risks that are faced by the treasury managers. Foreign exchange risk, interest rate risk, credit risk, liquidity risk. These are called financial risks. And apart from that, you get operational risk. Apart from that, you get operational risk. So the operational risk management is a different subject altogether, but operational risk involved provision of resources and infrastructure to manage the overall business activity of these financial entities. Then the financial risks are mainly handled by the treasury guys in fixing the interest rates, exchange rates for all these activities, and also managing the liquidity, providing funds for the business activities. So this is a good pictorial explanation for the overall treasury management in the name of asset and liability management. money brokers actually get their business volumes out of these fund management activities or asset and liability management activities of the financial institutions. Asset and Liability Management Committee, or the ALCO, and the Treasury. ALCO is appointed by the Board of Directors. Board of Directors are the representatives of the shareholders who have provided the capital funds. Shareholders appoint the Board of Directors, and the Board of Directors makes the policy decisions and are responsible for overall risks that the financial institutions undertake. And in turn, the Board of Directors appoint or hire the senior management team to manage the business activities. So there is an agency relationship. Board of Directors hire the senior management team. So actually the senior management team are agents to manage the business activity of the financial institution. And it concludes the staff members from Treasury and operations. It includes the staff members from Treasury and operations. It establishes the policies and guidelines for asset liability management. The Board of Directors is supposed to be establishing the policies. Basically, the so-called agents or hired senior management members should draft the policies, various kind of policies, including treasury policy and the investment policy and the credit policy, several policies. Altogether, there are about 30 or 40 policies for a banking institution. When it comes to the finance company, again, the number of policies should include more or less the same, but maybe less. And then the so-called policies drafted by the senior management members, the Board of Directors should approve. They can seek clarification and then amend certain aspects. After amendments, deliberations, they accept the policies and approve, and then from that point onwards, those policies become instructions to the entire workforce and the business stakeholders. So therefore, they become law or internal regulations. It monitors compliance to the policies. The Board of Directors then monitor the compliance to the approved policies through various board subcommittees, risk managers, internal audit, external audit, and finally by the compliance department. Then Treasury implements asset and liability management policy. Treasury implements asset and liability management policy. Credit risk. Credit risk per se is not managed by the Treasury, but there are aspects controlled by the Treasury, like pricing of loans and advances, when the pricing of loans or credit is excessive, naturally the borrowers may default and then there can be a lot of non-performing advances. So individual credit risks are handled by lending department. The loan applications processing, credit administration, recovery process, all done by the lending department. However, the fixing of interest rates through which there's a great impact on the recovery of loans and non-performing advances is the work of Treasury. Then the portfolio risk is major concern of ALCO. Credit policy is drafted by the experts of the credit department and approved by the credit committee. There's a board subcommittee called credit committee, and also by ALCO before final approval by the board of directors. Then portfolio risk measuring is again initiated by the credit department, and then is the job of the risk management department. Portfolio risk management again is by the operation level by the credit department, and at the tactical level by the risk management unit. Portfolio at risk. Outstanding principal of any delinquent loan is at risk. When you take the total loan portfolio individually, the credit administration department who administer the loans will know which part is delinquent or may become not recoverable. So that part is the portfolio at risk, and then very well can become non-performing advances in due course. So classification and aging of portfolio at risk is also used to manage the portfolio at risk. Then the portfolio at risk more than 30 days should be below 5% of total portfolio. These are statistical model driven. Now this theory can also be applied to the treasury bill and treasury bond portfolios or any other share market investment portfolios handled by the treasury. Mostly these calculations are done by the risk management unit. Then loan loss provisions according to the portfolio at risk it can be really estimated and thereby control the non-performing advances. So, portfolio at risk for different risk pools. Again, statistical model driven calculation. Diversify portfolio to spread risk. That is a risk management strategy to diversify portfolio to spread the risk, which is working very well when you handle a large pool of funds and number of portfolios in a large financial organization. So then we come to liquidity risk. Ability to honor all cash payment commitments as they fall due is the liquidity risk. Use of current cash inflows, stock of cash holding like wall cash, and the cash loaded into ATMs. Then the borrowing of cash, you may have heard most of the bank branches and the branches of finance companies in different geographical locations. When a branch of when one branch is short of cash, they have the ability to inquire about and then quickly transport cash from another nearby branch to meet any customer demand or any other payment requirement within a few hours time. That involves cash transport cost and then insurance. Similarly, they can also have arrangements with the branches of different companies or different banks. If a branch of a bank A, so for example in Kandy district, needs cash to serve a customer urgently, and other branches in the vicinity of the branch, if they do not also have cash, they can inquire from a few branches of bank B, C, D, E, and F, various other banks. And then whenever they have cash, they request a certain amount of cash that they require and bear the cost of transport and insurance. And also the total value of the cash will be credited to the head office account, bank account with the central bank by way of a RTGS message so that the value is exchanged. So converting liquid cash, converting liquid assets into cash, you can convert the tradable securities like treasury bill, treasury bonds, or any other tradable security into cash if the bank requires more cash to manage the liquidity. So liquidity risk management, there are few ways of handling the shortages. Liquidity risk is the possibility of negative effect on the interests of owners, customers, and other stakeholders of the financial institution, resulting from the inability to meet current payment obligations in a timely and cost-efficient manner. Because those liquidable, the near cash assets, liquid assets, converting to cash all of a sudden also can be costly, because take for example of selling a treasury bill or bond and then trying to generate cash, you may have to sell it at whatever the market available price. You may not have the chance of obtaining the best bid in the market. So there can be an opportunity cost. So therefore, there should be some skillful managing of liquidity by the treasury team. Funding liquidity risk. Funding liquidity risk is the risk that the counterparties who provide the bank with short-term funding will withdraw or not roll over that funding. Very simple example is that when you have depositors, the possibility that the depositors on maturity or even before the maturity has premature withdrawals, if they resort to take the money away, this risk will really aggravate when there are a very less number of depositors. If there are a large number of depositors, then the possibility of withdrawing funds by all the deposit customers is very less. That happens when you have only a few products, savings or current accounts or fixed deposits. When you have only a few products, there exists the possibility of the few depositors deciding to withdraw the money in the event that the interest rates offered by this particular entity is lower, or the services rendered by this entity is poor, or the reputation of this entity is not so good or damaged. So therefore, funding liquidity risk again is also subject to concentration risk. Concentration risk is that when you have only a few number of depositors, it's a risk of concentration. When you have a large number of depositors, the concentration risk is low. Then creating a run on the bank as depositors withdraw their funds. When there is a news on the social media or any other news media that certain bank or certain finance company has been unable to repay the depositors' money or run through certain bad patches of reputation, then the depositors might queue up in front of the branches to take their money out, withdraw the money. So that which will create a run on the bank. This is also often called an individual name crisis. I think you all use this term in the markets when you're dealing with the bankers and primary dealers, the name crisis. Some years back, the name crisis was with Ceylon Bank when there was a problem of intercompany lending, borrowing, and the Ceylon Bank group, in that particular group, Ceylon Bank was supposed to be the cash-rich company, and then they were exposed to those sister companies, and finally, central bank intervened, and then it was handed over to the bankers alone for management. In such an event, those other friendly banks who would have some limits approved to Ceylon Bank may also have withdrawn the limits because of the fear that if they lend to the Ceylon Bank in call money market or term money or in other treasury bond transactions, they might get affected. With that fear, they might withdraw those limits and a particular name crisis occurs. So finally, with the intervention of Bank of Ceylon, they were able to overcome the name crisis. And after a few months, with the change of the entire board of directors of the Ceylon Bank by the central bank, Ceylon Bank started improving their name and then came to normal operations. Market liquidity risk. What we discussed earlier is funding liquidity risk. Now it is market liquidity risk. The risk of a generalized disruption in asset markets. That market normally liquid assets illiquid. That make normal liquid assets illiquid. This corresponds to a systemic liquidity crisis. We may not have seen such. We have seen this, right, with the pandemic, when the central bank brought in several regulations, and also with the rupee depreciating at a rapid pace. The spot rate and the exchange rates spot market was virtually non-existent or defunct, isn't it? Then some smart bankers and brokers started quoting the spot next instead of spot or 1 week forward. But there again, central bank intervened and then prevented such transactions. I think even to date, the spot market, the forex market, dollar rupee may not have recovered fully. So therefore, market liquidity risk, we have an example in the recent past. This is a picture of the Northern Rock, a merchant bank in UK in the year 2007, September 2007, collapsed because of this particular risk. Actually, the funding liquidity risk. The story behind this Northern Rock is that although it was a well-established bank, they did not have much depositors, very less customer deposits with them. But they were resorting to using the capital and limited deposit base. They started lending to housing mortgage market. In other words, they took mortgage on the borrowers on housing loans. And as you all know, in those developed markets, the mortgage bonds, particularly housing mortgage bonds, are bundled together and sold to other investment banks and other funds at a price. Say, if a bundle of housing mortgage is worth £1 million, they might sell it to another buyer in the secondary market for £990,000, £10,000 being the discount or the interest component that is a profit margin for the buyer. Once you sell that, from that day onwards, the housing mortgage repayments go to the new buyer. So likewise, now when this particular Northern Rock Bank granted housing mortgages and then bundled them and sold it to second and third and fourth and fifth participants like a chain, Northern Rock gets its money. And the second bank who buy that, when they sell it, the second bank also gets their money. Like that, it's a chain reaction. It's like treasury bills and treasury bonds being sold from one entity to the next another entity. So when that happens, as long as the economy is working and the housing mortgage borrowers keep on repaying the housing loans in time, the mortgage market, the secondary market of the mortgage bonds performs well. And it had performed for several years and decades in the London or UK market and then other developed markets as well. Basically, it's a securitization of the mortgage bonds. So all of a sudden, when the subprime mortgage issue came, because the housing mortgages were usually granted for employed citizens who would have stable income to make the housing mortgage payments on a monthly basis. But when that market is saturated, this mortgage loan providing banks look for others who are with not so stable income for to grant the housing loans on mortgage of their property. So in the years 2006, 7, and 8, this subprime mortgage, those mortgage borrowers with not so stable income are called subprime borrowers. Borrowers. Those mortgage borrowers with stable income like permanent jobs, and then they are called general mortgage borrowers, good quality. But subprime category was also used when the stable borrowers were not coming forward anymore. That market was saturated. So finally, during these years, 2006, 7, 8, what happened was those subprime mortgage borrowers, one by one, they missed the mortgage housing loan installments on a few months intermittently. Finally, therefore, this not so well performing mortgage repayments and also other economic conditions and the interest rates prevailed in the UK market, the secondary market of the mortgage bond secondary market went into greater discounts. The price was, say, £1 million worth of mortgage bonds would have gone to about £500,000 or £400,000 or £300,000, a deep discount because of the subprime issue. So therefore, Northern Rock, while not having a broad-based deposit customer base. We're having a very few customers who are depositing money with them and resorting to the mortgage bond market to finance itself after having granted mortgage loans. They bundle and sold, then they generate cash. Then again, they start lending out the mortgage bonds. The second set of mortgage bonds are also then sold to this another investor like that. So all of a sudden, when the deep discount issue came on the secondary market, Northern Rock particularly ran into cash problems. They could not realize cash to finance new mortgage loans, and even the existing mortgage bonds that they are to sell, and then their portfolio was value less than half, or sometimes some cases one third. So therefore, that they ran into liquidity problem, the funding liquidity risk. So this is the picture is that the limited number of depositors in the Northern Rock queuing up in front of the Northern Rock branches to withdraw their money. That's what this picture explains. Then cash assets. Cash assets are currency bills and the coins or vault cash, currency notes and coins, vault cash, plus demand and transaction deposits, cash items in the process of collection. These are cash assets because they are either cash or near cash items. They are termed as cash assets. Then when it comes to liquid assets, it is cash assets plus other liquid items that can readily be sold for cash. Money market deposits, repos, short-term fixed income paper, like treasury bills and bonds. So that is liquid assets, total liquid assets. So the ratios normally expected to be maintained by the banking and finance companies, liquidity ratios, they say 20% or more of liquid assets belonging to these items. Usually the regulator, the central bank, would specify what item you can include in the liquid assets. So they are here. The 20% of total liabilities should be in these, because in case when there are liquidity issues, at least the 20% of liquid assets can be mobilized to honor the payments or the claims that arise. Goals of liquidity management. Honor all cash outflow commitments on a daily or ongoing basis. Minimize the cost of foregone earnings on idle liquidity. Minimize the cost of foregone earnings on idle liquidity, meaning you are keeping idle liquidity is a costly affair. You forego some income. So therefore, as long as your other contributing factors like the reputation, asset portfolios, and the liquid assets in the optimum ratios be maintained, then you can minimize the cost of foregone earning on your idle liquidity. You need not keep idle balances. You don't need to keep large amounts of all cash. Then satisfy minimum reserve requirements and other regulatory liquidity standards. Avoid additional cost of emergency borrowings and forced liquidation of assets. As I told you before, in case of forced liquidation, there can be a opportunity cost. You may not find the best bid in the market to liquidate your assets. So therefore, some part of the investment can be lost. Then liquidity regulations. Minimum reserves in the central bank, although the reserves maintained at the central bank are not really meant for liquidity purposes, but that helps. The purpose of maintaining reserves at the central bank is to contain the money supply. Because when you take a deposit of 100 million, when there is a 4% reserve requirement, 4 million have to be kept at the central bank. So the bank or the finance company is able to lend only out of 96 million. So that's the control of money supply. So, but exactly the purpose of reserve is the controlling of money supply, not to fund any liquidity crisis. But in a liquidity crisis, that those reserves also helps. Minimum liquidity and capital in the financial institution. Minimum liquidity and capital in the financial institution also helps. That is the reason why the central bank time to time requests or give directions to increase the capital of the banks and the finance companies whilst after assessing the market requirement or the size of the economy or the quantum of the transactions in the economy. Regular liquidity monitoring and then reporting. Regular reporting of liquidity in the current context, the central bank takes in liquidity positions of each bank and finance company on a daily basis. So they have statistical department who would support, who would help the bank supervision, non-bank supervision, and other departments like domestic operations and international operation department to manage the financial system or financial entities in the financial system. Then membership in a deposit insurance system or bank solidarity fund. In Sri Lanka, we do have a deposit insurance system. Deposit insurance system where banks are supposed to contribute to the deposit insurance fund maintained by the central bank. A percentage of the total deposits has to be paid to that fund because in an eventuality when any entity finds it difficult to repay the depositors, especially the small depositors after about 20,000 rupees, sorry, after about 500,000 rupees, 500,000 rupees, depositors are paid by this fund. So that's the purpose of the deposit insurance system. In Sri Lanka, we do not find bank solidarity fund, but deposit insurance system is there. Then the lender of last resort. It is the central bank. Any financial intermediary, a bank or a finance company, when they are unable to manage their affairs, central bank lends money at the rate of bank rate. I think the current bank rate is in the region of 10% or 12%. However, when the bank or finance company applies for funding under the bank rate, under the letter of last resort, central bank gets the signal that they are unable to manage their own affairs. So they would quickly move in, remove the board of directors, appoint a new board of directors and management, and take over the management of affairs in that particular entity. So therefore, we have not seen any financial entity requesting for finances under lender of last resort in the near past. Liquidity ratios. The common ratios used, the liquidity ratio, I was indicating it's something like 20% currently. And also we have liquidity cover ratio and net stable fund ratio also used from a few years back. Different way of computation, but they are very specific and then enable particularly the banking institutions to maintain high level of liquidity. Then cash position indicator, capacity ratio, purchase fund ratio. Purchase fund ratio is basically by way of funds borrowed or funds bought against collateral submitted by the institution. Total deposit ratio, total deposits to loans, loan to deposit ratio. I think we discussed that yesterday. Reserve ratio, current ratio. Current ratio is that the short-term assets or short-term liabilities, current ratio. Look at trends rather than absolute figures. Out of these ratios calculated, one has to look at the ratio of last month against this month, and then this month last year against this month as well. Like that, the trend has to be studied, and then only the decision can be made. This is an important subject, gap analysis, maturity mismatches. Basically, to explain in a nutshell, normally banking and finance companies borrow money on savings deposits, current account deposits, and fixed deposits. What is the longest maturity on these? Both savings and current account deposits are technically has to be repaid on demand. On demand, meaning the depositor of a savings account or a current account can withdraw the total amount of money within the next minute if they wish to. If the depositor loses the confidence trust in this particular banking institution or finance company, they can walk up and then demand withdrawal any point in time. And fixed deposits, there's a contractual obligation. If the deposit is for 1 year, until at the end of 1 year, only the depositor can withdraw. But however, the depositor can walk up to the bank or finance company and ask for premature withdrawals as well, citing some reason. So at that point, the contracted interest rate may not be paid, but a different, at least the savings interest rates can be computed and paid. So to explain the gap maturity mismatch, the longest deposit that are accepted by banks and finance companies is something like 5 years, isn't it? 5-year fixed deposit we have seen. But on the other hand, out of these deposits money, after keeping the reserves or whatever, they are on lent to customers by way of overdrafts, housing loans, working capital loans, project loans, and various other types of loan, leasing, credit cards, and then also trade finance, international trade. So on the loans and advances side, the shortest end of the tenor or the maturity is the overdrafts. When one overdraft is granted today, bank or the finance company might expect the money to be repaid tomorrow or day after or within a short period of time. But something like a housing loan can be granted for long as 20 years, 25 years, or even 30 years. Now, young guys like you all in the age of 20s or early 30s can apply and obtain for a housing loan for about 20 years or 25 years or 30 years. Because your retirement age might be about 55 or 60 years. So therefore, the lending institutions will consider if you have a proper job and then decent stable income, they would want to lend you money. So when you consider the deposit base maximum maturity products 5 years fixed deposits and asset base or the loan portfolio maximum loan period of 25 years, say, there's a gap, isn't it? And on these two gaps, on the two portfolios, deposit portfolio, majority of the deposits could be in the region of 1 year. But now, because of savings and current accounts, it can be even shorter. If the volumes on the savings and current accounts are large than the fixed deposits, the total major volume of deposit base could be less than 1 year. Whereas in the loan portfolio, take into consideration various personal loans, housing loans, and then project loans, all that, the majority of the loans or assets could be in the region of 10-year maturity. So loans majority are 10-year, deposit majority are 1 year. There's a 9-year gap mismatch. To match this mismatch, because the deposits are being renewed at maturity all the time. And then also when the economy is growing, more economic activities and the money supply levels in the economy will increase with the increased economic activity. So therefore, the bankers and finance companies will receive more deposits as time moves on because of the economy is expanding. So therefore, they wouldn't mind creating this mismatch, 10-year majority of loans as against 1-year majority of deposits, because this 1-year tenor of majority of deposits will eventually be renewed on maturity, and then new deposits will be also attracted to finance the 10-year or more assets or loans. So this is some sort of magic performed by the financial intermediaries, banks and finance companies to finance long-term 10-year or more assets through short-term 1-year or less liabilities. However, this magic will not be able to, or magicians will fail if their reputation is damaged. If there is any bad news about the performance, about the conduct of the activities of these banks and finance companies, then as we discussed before, there can be run on the banks. No new deposits come in. At the same time, the existing deposits also can be withdrawn by existing customers, like in the case of Northern Rock. So therefore, they have to maintain a good reputation, at reasonable and decent profit levels also is a must. So therefore, if those criteria and the compliance to the rules and regulation is maintained in a perfect order, then new deposits will build up. At the same time, existing deposits also can be rolled over by the deposit customers. So that's the magic, and the magician's performance will depend on the reputation and the good behavior. So in the treasury management, we have to compare the maturity of assets and maturity of liabilities on given periods, say up to starting with overnight maturity of assets and liabilities, then up to 1 week maturity of assets and liabilities, up to 1 month maturity of assets and liabilities, up to 3 months maturity of assets and liabilities. At least up to 3 months, there should be assets maturing more than maturing liabilities. Then only the liquidity can be satisfactory, or there will be positive liquidity gap. If by any chance, if in these short-term maturity buckets, if there are more liabilities maturing than assets, then there'll be a problem. Then the treasury guys will have to run around and then look for borrowing in the call money market or selling treasury bonds quickly to bridge that gap. Thereafter, after 3 months time bucket, there can be 6 months maturing assets and maturing liabilities, and monthly thereafter, or after 1 year, within 1 year, maturing assets and maturing liabilities, and beyond. So these measurements or the gap analysis is usually produced by the computers, the core banking systems of these banks and finance companies to help manage liquidity by the treasury guys. So maturity gap analysis analyzes when financial institutions will have too little or too much liquidity. Will have too little or too much liquidity. So that analysis has to be performed and reported to the senior management and the board of directors on a regular basis, to the senior management more or less on daily basis, and the board of directors on periodical basis. And then also the regulator will call for these statements, gap analysis, more or less on a daily basis. Contractual maturity of assets and liabilities versus behavioral maturity. Contractual maturity of assets and liabilities versus behavioral maturity. Contractual maturity can be produced in statistical mismatch tables. Behavioral maturity has to be studied and performed or built into the maturity mismatch tables. For example, in Sri Lanka, towards April, Singalan Hindu New Year festival time, or in December, the Christmas time, year-end period, usually bankers and finance companies experience a lot of withdrawals of deposits during the period running up to the Singalan Tamil New Year or the Christmas days. But soon after that, the cash flows back in. Why is that? Because most of the employees are paid their bonuses and salaries for festive celebrations during the period running up to the festive days. Then they go on shopping spree. The vendors usually collect cash, sale proceeds, and then bank them with after the sales happens. So therefore, the cash flows in with the festive season or after the festive season to the banking institutions and finance companies. So that's behavioral maturity. If you need to ascertain a greater degree of accuracy of maturity mismatch forecast, that type of behavioral maturity also can be built in with past experience. That the loan portfolios should be considered as long-term assets. But with the contract period, it can be built in. And then also loan portfolio, the loan repayments also can be, depending on the portfolio, can be ascertained by the computer systems and can be posted on the inflow side very accurately if the computer system is robust and comprehensive. One other factor is that course deposits should be considered long-term liabilities. There's an explanation towards that, where the savings deposits and the current account deposits, we discussed that they are on-demand funds. However, usually the bankers and the finance companies experience that only up to about 5 or 10% maximum of savings and current account deposits are withdrawn on a daily basis, mostly less than 5%. But at the same time, there are new deposits that are coming in or made to the savings accounts and current accounts. So the total deposits in the savings and current accounts actually grows with time period, provided, as we discussed, the reputation is good, the behavioral factors are positive, compliance to the rules and regulations are made positively perfect, then the core deposits, savings and current account deposits, if you are 100 million each of, shall we say, 100 million of savings deposits and 50 million of current account deposits, of which only 5% might be withdrawn on a daily basis, but at the same time, there can be new deposits coming in. So what this suggests is that balance 95% of the savings and current accounts, 100 million and then 50 million respectively, can be considered long-term. Now, that factor must be properly studied for a past 3-4 years, and the ALCO must take a considered decision. Shall we say 90% of the total savings and current accounts, savings 100 million, then current account 50 million, 90% of that, meaning savings deposits 100 million, out of that 90% is 90 million, current accounts 50 million, 90% of that is 45 million. So 135 million of savings and current account deposits can be considered core deposits, which will not be withdrawn because the reputation is managed very well and the compliance and the behavior is superb. So therefore, you can expect new deposits to come in, and only up to 5% withdrawals can be expected on a daily basis. So therefore, this 135 million can be on the maturity mismatch or maturity gap analysis. The liabilities of 135 million of savings and current accounts can be posted to 1 year or more, long term, although they are technically on-demand withdrawable funds, technically on-demand funds, but because they have become a core deposit base, the 95% of savings and current accounts, it can be posted on not en bloc, but ALCO might decide, say, out of 95%, 50% to be posted on 1 year and more, and 20% to be posted on the 3 months basis, and 25% to be posted on the 6 months basis. Like that, scattered posting also can be done, segregation also can be done to be on the safe side, as well as to assess the maturity mismatches on a prudent basis. So this helps the liquidity measure to be more realistic and to be on the conservative basis. Because after all, this is going to be an estimated liquidity forecast for the time buckets in front of us for future. Stress testing, crisis scenarios. Now, stress testing is basically on a estimated or forecasted crisis scenarios, how well the funding requirements or shortfalls can arise. So they are called stress testing, crisis scenarios. Based on the maturity gap analysis, different crisis scenarios can be simulated. It's a matter of simulation. Stress testing allows a financial institution to project funding shortfalls with specific runoff assumptions for demand and other short-term liabilities. You can build in various scenarios forecasting a crisis. Now, for example, this pandemic era can be forecasted, whereas in the pandemic era, most of the loan borrowers may not come out with the loan repayments on a monthly basis. A percentage can be estimated, and the loan repayment figures can be adjusted to with those percentages onto the lower side. And at the same time, new loans granted can be also lower. So that those numbers with the past experience, whatever experience in the past, the numbers can be reduced. Then definitely the deposits also may be on short supply. So the new deposits increase also has to be adjusted. So likewise, the crisis scenarios can be simulated with given assumptions. So the stress testing allows a financial institution to project funding shortfalls with specific runoff assumptions for demand and other short-term liabilities. Then stress testing helps to set limits and to define a crisis plan. If by any chance, if in one of the buckets, maturity bucket, the maturing liabilities become more out of this estimated scenario, assumed scenarios, then a defined crisis plan can be planned and adopted before the actual time comes, such as liquidating treasury bond portfolios or collecting the wall cash sitting around in the branch network around the geographical areas, and or resorting to call money borrowings, oils, discounting the treasury bills, treasury bonds, and other central bank securities with the central bank auction windows. those type of action plan can be drawn up and keep everything ready for execution with the timing that is predicted by the maturity gap analysis. Reputational stress event starts today and lasts for 3 months. Voluntary retail deposits run off by 30% over 3 months. These are assumptions. Then large time deposits run off by 50% over 3 months. Unused overdraft lines of credit are cancelled by correspondent banks within first month. Unsecured overdraft utilizations must be paid back within 3 months. No new long-term borrowing, schedule fresh draws on existing funding lines are being delayed by counterparts and do not become available during the 3 months. Maximum standby facility from parent network is drawn after 4 weeks. New lending is limited to prolongations for core clients only. No new borrowers accepted. Collection ratio declines from 95% to 80%. That is the collection means loan installments. Liquidity planning, basic idea of dynamic liquidity planning based on cash flows. I just suggested some items thinking that January 1st, January 2nd, January 3rd, January 4th, like that. These type of tabulations are possible with accurate figures if you have the core banking system computer framework. Saving deposit customer A 10 to come in, disbursement of loan B 30 minus on the 1st of January, like that. And then our daily cash change is plus 5 on January 1st, plus 25 on January 2nd, plus 5 on January 3rd, minus 60 on January 4th. So cumulative cash balance, cumulative is January 1st, 5 plus, then January 2nd, there's additional 25. So 25 plus 5 is 30. Then January 3rd, another 5 comes in. So 30 plus 5 is 35. But when it comes to January 4th, 60 minus. So 35 plus and 60 minus, 25 minus. So there should be a plan to meet this 25 minus by the January 4th to meet the 60 branch payroll distribution disbursement. There should be a generation of 25 by the 4th of January. So this is basic idea of dynamic liquidity planning based on cash flows. The customer transactions cannot be planned individually. However, statistical measures to forecast aggregate customer assets and liabilities needed. All this is possible when you have a computer stored data. No one can imagine to do it manually on books and paper because it can be, there can be a lot of errors in collection and human errors also possible. So therefore, it is basically a computer simulated program. Cash flow forecast, aggregate loans and client deposits forecasting, cash losses from loan operations, cash flows from long-term financing and investing, cash flows from short-term financing and investing are not considered. Stress testing, all cash is planned separately. All cash is planned separately. For each and every item, there should be knowledgeable input by the respective experts in the respective field, so that the final product, the cash flow forecast, will be accurate and then near reliable figures. Liquidity management instruments. On the asset side, minimize opportunity costs, settlement liquidity, central bank balances, money market deposits, investments in short-term fixed income securities, cash from less liquid assets can be used with minimizing opportunity costs. Then on the liability side, diversify funding sources, money market borrowing, large brokered time deposits, liquidity pool. So these also can be good sources of funding in liquidity management. Securities. Investment in securities serve as an asset store of liquidity that minimize the opportunity cost of idle cash. Properties of eligible liquid short-term investments, fixed income security, negligible credit risk, public sector issuers, short time until maturity, no interest rate risk, liquidity secondary market, liquid secondary market, low transaction cost, and rapid execution of trades. So properties of eligible liquid short-term investments, which become helpful to manage liquidity. Additional forex exposure from investment not desirable. Additional forex exposure from investment not desirable. That is because exchange rate risk, particularly the Sri Lankan type of rate movement or depreciation of the rupee will affect. However, particularly the commercial banks have been using the foreign currency deposits swaps to help out with the liquidity management on an increasing basis. Then typical investments are in actively traded treasury bills and bonds with time to maturity below 1 year. So the treasury bills and bonds investments also can be used. There again, after investment, yesterday we discussed 3 business models: held to maturity, available for sale, and held for trading. They can be used once they are in a portfolio, and as the days pass by, they must be, the maturity dates must be diarized, and the computers, of course, will be able to do it. And typical investments are actively traded treasury bills and bonds with time to maturity below 1 year. So the accurate maturity date can be recorded in those maturity buckets. All right, I think we have reached the allotted time. So therefore, we'll leave the rest of the slides to be covered tomorrow. Any question? You might think that this is a high-profile treasury management, but what you all are also doing is partly getting involved in treasury management of these institutions. So this additional knowledge that is being discussed is really helpful in executing your role as money brokers. So I hope you all at this young age or being young adults, you should strengthen your knowledge on a daily basis and not stop your acquiring knowledge after this course. You must continue pursuing higher studies, even if you don't go for completing other exam courses, degree courses, master's courses, or PhDs, but acquiring and gathering knowledge on a daily basis is really going to help you with your profession and on your job. So I know there won't be questions or comments. Everybody is behaving like they have understood everything. Anyway, let's see your assignments, how they come. And then see you tomorrow at 4 p.m. Good night.
Thank you, sir. Good night.
Thank you, sir.
Thank you,
Good
sir. Good
night.
night.
Nilok, how was the topic?
Yeah.
Nilok, how was the topic for the assignment?
So we decided on doing our topic is basically facing the gearing the financial markets for post-COVID era. So
Post-COVID era. Okay.
what
Okay.
we intend on kind of breaking it down into four different segments and addressing it among us.
Okay, good. So
Yeah.
please send me the
I
the
actually sent
email.
it during. I actually sent it once the class started, so I have
Ah,
emailed it already. But that's the topic, sir.
okay. So send me the subtopics also that are yeah.
Oh, sure. Tomorrow morning, I will send the breakdown of the subtopics also.
Right.
Basically, we want to address like the forex side, the interest rate side, and the macroeconomic side.
Very good. Okay.
Yeah. Okay.
So who are the others who are not yet submitted? Iran, have you done? Kavidi? Anyway, please send them in quickly because I want you all to start. All right. Okay, then have a good evening.